Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
This week we have a strategic briefing that is, well, it's genuinely binary.
It is. We're talking about the biggest regulatory gift to UK banks in over a decade.
Immediately offset by a massive new systemic risk alert. We're unpacking the Bank of England's first major loosening of capital rules since the global financial crisis.
And that's the certainty part. The panic comes from the bank's stark warning about an AI debt bubble.
A bubble fueled by a projected $5 trillion in spending.
Exactly. And the persistent, the hidden vulnerabilities deep within the non-bank financial institutions sector.
Plus, we'll cover the messy political fallout from the OBR's chaotic budget blunder, the new timetable for Basel 3.1, and the near-epidemic surge in friendly fraud.
And the new DWP powers requiring banks to perform eligibility checks.
So if you are responsible for risk, strategy, or conduct, you really need every detail from this one.
We have clarity on the regulatory floor, which provides massive confidence.
Right alongside huge new macro warnings that demand immediate changes to credit risk models. Let's jump straight into that major announcement from the Bank of England.
Okay, so let's unpack this. The FPC has lowered the benchmark for system-wide Tier 1 capital requirements.
They've cut it from 14% down to 13% of risk-weighted assets.
Which, on the face of it, sounds like a small shift, a single percentage point.
But isn't, is it? I mean, the regulatory community is calling this the first major loosening we've seen since the 2008 crisis. It's historic.
It is, and it signals two things, really, confidence and opportunity.
The bank is basically confirming the sector is fundamentally stronger post-GFC. Much better underwriting standards.
So by reducing this target floor, they're providing genuine regulatory certainty.
But how does that 1% reduction practically translate into more lending? I mean, surely banks weren't sitting right on the 14% line anyway. That's the key point. It's not just about releasing capital, it's about reducing the incentive to hoard it.
To hoard it above the regulatory minimum.
Exactly. The FPC judges that 13% is entirely consistent with long-term resilience. By clarifying that benchmark, banks know precisely what they need to hold.
Which frees up existing capital for deployment.
Right. And this confidence is clearly rooted in the latest stress test results.
Absolutely. The December 2025 Financial Stability Report confirmed the UK system is, and I'm quoting, strong enough.
Even against a really severe scenario. We're talking GDP falling 5%, unemployment soaring to 8.5%.
And under that scenario, the impairment charges were, they were substantial.
But manageable. We saw £12.3 billion projected for UK mortgage impairments.
And a pretty hefty $29.3 billion for UK consumer credit.
And all this resilience has prompted the FTC to look at future strategy. They're explicitly committed to enhancing what they call buffer usability.
This is the drive to stop banks maintaining internal buffers far, far in excess of what's required.
We've heard that term bufferati mentioned by senior regulators before.
Yes. For those not deep in the PRA's thinking, it's about making capital buffers genuinely usable in a downturn.
Without the bank basically paralyzing itself.
Exactly. Historically, dipping into those buffers carried a huge stigma. It prompted immediate market concern.
So the FPC wants a simpler structure, maybe a single releasable buffer.
That's the idea, something that makes banks confident they can actually use it without penalty, and therefore support lending when the economy really needs it most. It's a crucial shift.
Speaking of regulatory certainty, we also have final confirmation on the bulk of the Basel 3.1 timelines.
Yes, the vast majority of those rules in the UK are still set to come into force in January 2027.
So that's the strategic baseline for preparation.
That core date is fixed. The PRA has been very clear there won't be further substantive changes to the main package.
But there is a crucial targeted delay.
There is, yes. For global institutions with complex trading books, we're talking about the modeled part of the market risk rules.
The fundamental review of the trading book internal model approach. The FRTB-IMA.
That's the one. It's being postponed until January 2028.
And the reason for that?
Well, Phil Evans put it down to the need for consistency. The UK wants time to finalize its rules in light of what's happening in other major jurisdictions.
So the U.S. and the EU.
The U.S. and the EU. This synchronization is vital for, genuinely global and cross-border business.
You hear the rule called fundamental. So what is the FRTB actually meant to fix strategically?
Well, there are three core problems from the GFC that it addresses. First, it clarifies that often quite subjective boundary between the trading book and the banking book.
Okay.
Second, it drastically improves the standardized approach to market risk calculation. But the most important thing is it improves risk capture, meaning it ensures capital requirements truly reflect those missing risks. Things like the liquidity or the lack of it of trading book positions. If you can't sell an asset quickly, the risk calculation has to account for that. The old rules just didn't do it properly.
Right. Now we switch gears from that structural certainty to an outright systemic warning. This is where it gets really interesting.
The Bank of England is ringing the alarm about an AI debt bubble.
They've explicitly flagged this in the Financial Stability Report. It feels like a high-priority risk now.
It's a major departure. The data behind the warning is, frankly, phenomenal. Industry forecasts suggest spending on AI infrastructure could top $5 trillion
Or 3.8 trillion pounds.
over the next 5 years. The sheer volume is terrifying. But the key metric for the bank is the funding source.
And they've noted that about half of that colossal sum is expected to be funded externally.
Primarily through debt.
Which is why the central bank is warning, and I'll quote here, deeper links between AI firms and credit markets mean that, should an asset price correction occur, losses on lending could increase financial stability risks.
We saw what happens when leveraged valuations detach from reality in previous tech bubbles. But are UK banks directly holding this AI debt? Or is the risk hidden further down the chain?
In the MBFI stack, you mean? Private credit funds.
That is the right question. The risk is becoming concentrated in the MBFI sector, which is why the bank is scrutinizing it so closely. This AI risk sits right alongside the continuing issue of high leverage in private markets.
We saw hedge fund leveraged borrowing in the gilt repo market reach nearly £100 billion in November.
100 billion. And that concentration risk is frightening, particularly because a tiny number of funds account for over 90% of that borrowing.
What's driving that colossal figure?
It's largely driven by the cash futures basis trade.
Yeah.
For our listeners who aren't in front office trading, this is basically an arbitrage strategy. So funds simultaneously buy the underlying gilt asset while selling the gilt futures contract, or vice versa. They're trying to profit from tiny discrepancies between the two prices.
And because the margins are so thin?
They have to use massive leverage, sometimes 50 or 60 to 1, which requires huge amounts of short-term gilt repo borrowing, and that increases refinancing risk across the entire market.
That leverage and concentration is exactly why the bank is launching a dedicated system-wide exploratory scenario.
The SWS, yes, focus specifically on private markets, starting in early 2026.
They want to test this largely untested resilience under stress.
And we'll see a final report in early 2027. This is a direct response to the kind of opacity we saw with U.S. corporate defaults like First Brands, which relied so heavily on private credit. The bank knows the next crisis might not come from the core banking system.
It might come from the shadows.
Precisely.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more compliance professionals like you.
Okay, moving from macro risk to conduct. The FCA is trying to get proactive about innovation.
With this new provisional licenses authorization regime.
That's right. It's established by the government specifically to help early-stage firms, particularly fintechs.
The ones who often struggle to meet the full authorization conditions straight away.
Exactly. So these firms get to undertake limited, time-limited, regulated business, but under close supervision.
With the clear goal of moving them towards full authorization, it seems like a practical way to reduce friction.
It is. And it's paired with a move to improve data quality in compliance. The FCA is streamlining how firms report complaints.
They're introducing fixed 6-month reporting periods for all firms, starting mid-2027.
Which should make benchmarking across the industry a lot easier.
But the real operational headache for retail payment systems right now is still this surge in friendly fraud.
Or false chargeback claims. It's where a customer disputes a legitimate purchase they willingly made. The statistics are, frankly, alarming.
How alarming?
Globally, LexisNexis reported that this type of first-party fraud increased from 15% in 2023 to a shocking 36% in 2024.
36%. So it's now the #1 reported fraud category.
It is. That's explosive growth. And it's causing real harm to small merchants. They lost over £500 million to fraud last year.
Is this a failure of technology, or is it a regulatory gap in the chargeback rules?
It's largely a failure of the mechanisms themselves. They were designed for old-school card payments, not modern e-commerce, so they often fall outside consumer protection rules. The merchant is left completely exposed.
And that anecdote about the London business owner physically visiting customers' homes to get his money back, it just highlights how inadequate the system is.
It really does. Compliance teams have to prioritize enhanced identity verification and better merchant protection, and fast.
Looking ahead, there are also big data governance changes coming.
Yes, new legislation is granting the DWP powers to require banks to provide account information.
This is to verify eligibility for 3 specific benefits: universal credit, pension credit, and employment and support allowance.
A key detail, though, is that state pension recipients are fully exempt.
Implementation starts in April 2026, with full operational use targeted for 2031. It's a long project.
It is, but the mandate is clear. And crucially, the legislation includes safeguards requiring human involvement in all final decisions.
So that's directly addressing those concerns that were raised in Parliament about algorithmic bias.
Exactly.
Now, technology isn't just about risk and bubbles. UK banks are actively using AI for good, too.
They are. Santander UK, for instance, is using an AI model trained to identify suspicious patterns that could point to instances of people trafficking.
That's a phenomenal use case, generating hundreds of leads for the authorities.
Absolutely. And Lloyds Banking Group is making a massive dual bet on transformation, targeting the UK property market.
Using both advanced AI and blockchain. Unpack that for us.
Well, firstly, they're rolling out what they call an agentic AI financial assistant
To over 21 million customers, starting from 2026.
And an agentic AI is different because it doesn't just answer questions. It acts autonomously to complete complex tasks.
Like guiding someone through buying a home or automatically verifying underwriting criteria. An AI that's a proactive financial concierge.
Precisely. And secondly, they've invested in CoEdute. That's a blockchain network designed to create a single, secure, data-sharing property grid.
Connecting estate agents, conveyancers, and lenders.
It moves the property transaction away from all those fragmented systems and towards instant, transparent data sharing.
Sounds like a long overdue fix. And finally, on digital currency, the Bank of England is still exploring the digital pound.
And they're inviting companies from all sectors, not just those already in the lab, to apply for case studies.
The deadline for that is January 9th, 2026.
We close this week with the political chaos surrounding the integrity of fiscal information.
The OBR, its chairman Richard Hughes, resigned, taking full responsibility for the early publication of the Economic and Fiscal Outlook.
The document, with all the core budget numbers, was accidentally accessible online 45 minutes before the Chancellor even started speaking.
And the internal investigation concluded the root cause was a pre-existing weakness in the OBR's WordPress system.
A weakness involving predictable hidden URLs. And, unbelievably, the report revealed a similar breach happened during the March spring statement.
A repeated procedural failure on market-sensitive data is, well, it's deeply concerning.
The political noise, of course, centered on accusations that the Chancellor had misled the public.
But if we step back from the political fallout, why does a procedural failure 45 minutes before a speech matter so much for market integrity?
Because that data release directly impacts gilts, currency, equities. Any unauthorized pre-knowledge of those key fiscal numbers, even if it's accidentally gained, creates opportunities for unfair trading.
And it damages confidence in the official release mechanism.
Regulated markets require a zero-tolerance approach to leaks of this nature, intentional or not.
And just one detail that emerged from the budget itself.
Properties classified as social housing are explicitly exempt from the new mansion tax surcharge, even if they are valued above the £2 million threshold. A niche, but politically charged detail.
So let's wrap up with the 3 critical takeaways for you in risk and compliance this week.
First, on capital strategy. The FPC has set the capital floor at 13%. That gives UK banks clear regulatory certainty and more space to confidently support lending.
And it shifts the focus internally to buffer usability.
Second, tech credit risk is redefined. The BOE has officially flagged the AI debt bubble, potentially fueled by that $5 trillion in leveraged finance.
And continued MDFI leverage as high-priority systemic risks.
So credit risk teams must adjust their models to account for this concentration in the tech and non-bank sectors.
And third,
Third, data and conduct demands. Retail banking must prepare operationally for the new DWP data sharing requirements starting April 2026 and urgently improve fraud mechanisms to counter that explosive rise in friendly fraud.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.